question. Okay, so let's do undo questions to do with the aspect of depreciation. Okay, so when you talk about depreciation in accounting, okay, so depreciation, okay, is just the loss in value of assets, loss in value of assets. So of course, we'll be able to look at the type of depreciation called, type of the method of depreciation. We'll be able to look at the method of depreciation called the straight line method. Okay, so straight line method. So this is a depreciation, okay? This is the depreciation. That applies on the net book value of assets. Okay, so that applies on directly on the cost of assets. It's a depreciation that applies directly on the cost of asset. Okay, so straight line method of depreciation is equal to cost of asset, so cost of asset then minus residual value. So residual value over number of years. So cost of asset minus residual value over number of years. So let's calculate this equation here. Right. Okay, so how would we get to this question? You can read the question for me. Question 2. What is the question about? Read this question for me.
So it's saying a company bought a machine for $30,000. It is estimated that the machine has a useful life of 5 years and will have a scrap value of $2,000. It is the policy of the company to depreciate machinery during the sum of years digits method.
Okay, so there's that one. Sum of years. Okay. So
it's saying calculate the depreciation of the machine.
I don't have to calculate the depreciation. All right. So using what? The sum
Are
of
we
it.
going to use the straight line method
Okay.
since it applies?
Okay. No problem. No problem. We will use both methods, but I'll start with the straight line. So if you are to use the straight line method, what would be the answer? What is the cost of the machine? I gave you the formula, not so.
Cost of machine, which is the cost of assets, is 30,000, right?
Mhm.
Then is the 2,000 the residue value?
The 2000 is residual value is a residual value 2000. Okay, so 2000 is the residual what?
Okay.
Value. So meaning, if you are to use the straight line method, what will be the formula? The formula which I gave you was how much? The cost is how much?
So
The
the
cost like
cost would be 30,000.
okay, so meaning what would be the answer using the straight line?
5,600.
5600. Let's confirm. So this one, so it will be 30,000. Then minus the 2000, then divide by 5. So
5
this other one,
to the value.
it will be what?
This is 28,000.
It will be
112.
28,000 divided by 5. Okay, so this is giving us what? 5,000 what?
$600.
5,600. Okay. All right, so this is using the straight line method. Okay. So now if you can do an activity table here, let's do an activity table first of all. You can do an activity table. It can even show you because here you are going to have here, which is 1, 2, 3, 4, 5. The cost is how much? 30,000. Okay, so this is the cost. Then this is the cost. Then you also do the dip. Then this other side you do the NPV. Okay, so NPV, you know, is a net book value. Net book value. So here, our dip is 200. What's the depreciation? If we can do an activity table using this one, it will be 5, 6. Okay, so when you do the 5, 6 here, okay, so meaning what happens, what's our book, what's our net book value for the first one? So to be 24 what? Year one, to be 24, 400, not so. Are we together? Are we together?
So we're subtracting 5,600 from 30,000, right?
Yes, yes.
Okay.
So, all right, so this one goes. Again here, you're going to our book, you put the 5, 6 here. Okay. 18,800. 18,800. So here again it will be 18,800. Okay, minus 5, 6. Which will give us what? 13, 200.
13,200.
So again here you come 13,200 minus 5, 6. So what are we getting? You're getting 76.
Yes, 76.
So 76 now. Okay, minus what? 5, 6.
5,600. So the remaining will be 2,000.
So we minus 2,000. Okay, so the 2,000 is the one they said, see what is remaining, which is the residual value. From the question,
Mm,
you understand what I mean?
yes.
All right, so yeah, so I'll audit the other method. So in the next year, I need to do a counter check just a bit on the sum of years digital method, not this other method time. So we'll do it the next attempt. Don't worry much about it. It's just a small clarification I need to counter check on that one. Let's answer part B. So far I've just explained the straight line because it counts, but this other one would do it in the next class. So it's something you need to work today. Okay, let's go to part B of this question. Part B says what?
And the following balances have been extracted from Kaunda's ledger
Okay.
accounts as at 31st December 2016.
Mm.
So that's the information. So it's required compile Kaunda's trial balance as at 31st December 2016.
Okay, thank you very much. 15 marks. So this one, trial balance checks the accuracy. of the double entry system. So what happens for this one? This one is a debit. All assets or debit balances. So this is a D. So all these, the ones I'm putting in the, or we're putting in red, they should have a debit balances. So this debit, 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 and debit. So those are debits in red. So the ones in blue are credit. So this is credit, credit, credit. So these ones, the credit. This one is also a credit. This one is also a credit. Okay, so those ones are credits. So what happens here is that as we prepare a trial balance here, we are going to do this debit and credit. So you will go. The first one is the bank. So bank comes here, 15,000. Then we have what else? Cash is 3,000. Debtors debtors. So debtors 10,000. Then your drawings is 5,000. Then what else? Electricity 4,000. Then we have furniture 7,000. Then you have office expenses. So office expense, how much? So office expenses 3,000. Salaries, and wages, 25,000. Then creditors, creditors 4,000. What else do we have? Capital, our capital is how much? Capital is 18,000. So these figures, where are they might I'm getting them from? Here. You understand what I mean? Is that clear? Is that clear? Hello, is that clear? Are you able to follow through?
Yeah, we are following.
So,
Yes, sir, we're following.
Baron, you have a problem? Madam Chileshe,
I know some following.
yeah, so let's add, sales is 100,000. So let's add the total here. So this is giving us 120.
Oh, yeah,
Yes.
122,000, right?
Mm-hmm. Then this other one here, you can,
It's also giving the same value.
okay. So 122,000, right? 122,000. All right, so this is it, what goes on here. All right, so this is what goes on. Okay, so I'm sure you have followed so far. 122,000. So this is how these questions are supposed to be answered. Okay, I'm sure it's okay. Then identify 5 users interested in financial statements. 25, and explain why they need financial statements. You can identify one of them. Users of financial statements. Who are they? Who are the users? So number one, so we talk about employees. Okay, employees, customers, who else? Suppliers,
Yes. We also have shareholders and lenders.
we have the government, okay, and shareholders. So the employees are interested in because of why do they need this information? Because they are interested in job security. All right. Is the company going to continue operating for the next future? Or we have a problem. We are making losses. You are an employee, you're just seated. You don't know what is happening. You are just seated. You discover that the company may downsize because you need to get a salary at every other time. Okay, so they're interested in the job security. Then customers that are interested in knowing are they going to continue buying from that organization. Okay, these customers are also called what? Debtors. Customers or debtors. Customers or debtors. So that's my debtors. Then these ones are also called creditors. Okay, so this is what is going on. So suppliers are interested in knowing, are they going to continue supplying goods to that organization? So they're interested in, are they going to be paid for the goods that are supplied on credit to that organization? So they cannot continue supplying. The company is not doing fine. So they cannot continue supplying if they know that they are going to recover their, their money. They will be paid for whatever they supplied on credit. Is that okay? Madam Chair?
Hello, sir.
Yeah, so what I'm saying is that the,
Hello.
the suppliers are interested in knowing if the company is doing fine so that they know that they will be paid, they will be paid money for the goods that they supplied on credit. Is that clear?
Yes.
Then what about the government? Explain something. Why the government will need something? Explain if you have an idea. Why should the government know about the financial performance of the business?
I think, okay, in terms of tax, I think they use the information to verify the accuracy of the reported profits and ensure that the correct amount of corporate income tax or VAT are paid. or if they are being compliant.
Yeah, so the government is interested in the amount of taxation that you collect. Okay, the amount of what taxation that you collect from the organization. You get my point, right?
Yes.
They are interested in the amount of tax collection from the organization. So that is what goes on. Okay, so that's why they're interested in the financial performance of the business for tax collection. Then the other aspect, shareholders, they believe in the dividend payout to them. So if the company is not doing fine, because the dividend is the profit that they is distributed to them. Okay. So this they believe in what? The dividend payout to them. They believe in a dividend payment. So dividend payment, okay, to them for wealth maximization. Wealth maximization. So this is what happens. You understand what I mean, right? So for you to get your what? Your 10 marks in an exam. All right. Okay, so these are the users. Now let's talk about part B. Outline any two ratios here in profitability. Any two ratios for under each of the following and explain their significance. So these are they are therefore under what we call interpretation of financial statements. These are what we call financial ratios. Okay. So financial ratios. Under financial ratios, what are we going to do? We are under profitability. So under profitability. We have number one, GPM. GPM is called gross profit margin. So GPM is called the gross profit margin. Gross profit margin. So a gross profit margin is going to be given by what? So
It's a gross profit minus revenue over
it is equal to
gross profit over revenue times 100.
Yes, gross profit. So gross profit over what? Over sales. Over sales. 100%. Okay. So what about this one? Net profit margin. This is called net profit margin. You know what the net profit over sales? Net profit over sales times 100%. Okay. Net profit over sales times what? 100%, right? So it will show it will show if the company is doing fine in terms of gross profit for the 2 years. So like an example, this is 2025, 2024, or in 2025. If the GPM for these two, GPM, it was 20% here, and then here, if it is 30%, what happens? Is the company doing fine?
I think looking at the percentages for GPM, the company was doing better in 2025 compared to 2024.
Then for the other one,
Then for the other one, for NPM, the company was doing better in 2025 than in 2024 than 2025.
okay, so that is correct. That answer is very correct. So you can see that in terms of GPM, there's a reduction in terms of profit making, right?
Yeah.
So let's look at now the other ratio, which is the liquidity. So under liquidity shows the company's position to what? Shows company's position to meet liabilities. Is therefore due. Okay, so is therefore due. Okay. So we have what type of ratio? Current ratio. So current ratio, okay, is equal to current assets over current liabilities. Current assets over current liabilities. So if the ratio is above 1, so like an example, if you have current assets of 40,000, and then the liabilities is 20,000. Meaning your asset is 2 to 1. You are better. You are in good, in good condition. Okay, because of the fact that your assets are actually more. Okay, your assets are actually more than your liabilities. You can sort them out. You can pay off your liabilities. The other one is quick ratio. So quick ratio is also called acid test ratio or acid test ratio. So under this ratio, we simply say is equal to current assets minus stock. Okay, over current liabilities. So even here in both cases, the ratio should be above 1. Okay, so if the assets are less than the liability, then you're not doing fine because you fail to pay them as they come to make noise. That's what it means there. Okay, so that's what goes on as we look at the quick ratio. So this is under liquidity. Okay, so the first one was the under profitability according to this question. So we have sorted out profitability, 2 ratios, liquidity, efficiency, two ratios under efficiency. So 2 ratios under efficiency. So efficiency, what does efficiency represent?
Sorry, I have a question.
Yes.
So under the quick ratio, so for current ratio, we said the ratio should be 2 to 1. So meaning the asset has to be more than liabilities.
No, this is
To
just
know
an
the
example. This is just an example I gave you. But we should just know that your asset should be always, if the liquidity position is good, your assets should be more than the liabilities.
Okay.
Is that clear?
Yes.
Then we have efficiency ratios. Number 3. Okay, so efficiency ratios. So they show companies, or they indicate how long the company is taking to pay. Okay, so you just simply say shows. Okay, so shows how long the company is taking to collect money, to collect money from customers. And how long the company is taking. And so also shows how long the company is taking to pay suppliers. Pay suppliers. So this is what goes on. So we are what we call data's collection period. So data's period is equal to data's over what? Sales times 365. Then that's a data's period. So you should need to collect money from your customers first, but it delay to pay suppliers. So here we have now creditors days, creditors days. So it's equal to creditors over purchases, creditors over purchases and 365. So creditors over purchases times 365. So this is it. That these are the two ratios under efficiency. How long are taking money how long are taking to collect money from your customers, and how long are taking to pay suppliers? Then the last one is investment ratio. It's called investment or investors ratio. That's the last one now. Investment ratios. Okay, so number one is earnings per share. Okay, or we can say dividend per share. Dividend per share. The dividend per share is equal to total dividend paid, total dividend paid over total number of shares. So total dividend paid over total number of shares. That's a dividend per share. And then the other one, we have earnings per share. Earnings per share, EPS, is equal to earnings after interest and tax over number of shares.
You said that earnings per share is equals to what?
Earnings after interest and tax. EAIT. Earnings after interest and tax. Earnings after interest after interest and the tax. All right, so these are the two ratios that are here. And of course, I can incorporate another one where we see return on equity. Return on equity is equal to net profit before tax. Net profit. It is net profit after tax. Over shareholders equity. Over shareholders equity. All right, so these are the ratios that we should fall under these ones. So under investment, we have these ones. I can put another one. If you want market price per share, market price per share is equal to earnings per share multiplied by price earnings ratio. Price earnings ratio. Market price per share, earnings per share multiplied by the price earnings ratio. All these therefore under investment ratios. All right, is that clear? Okay. Is that okay? Have you understood? Hello, have you understood? Have you understood? Okay, so we can end here for now. So we've covered the two components of topics here: interpretation of financial ratios and the trial balances. Okay. All right. For now, right. So I end the class.